All right, today we are going to answer a recent question we received that is a really good question, and a lot of times people ask. If they don't, we always try and ask it for them and then provide an answer because it provides some fantastic awareness. The question specifically is, if you don't max out your PUA rider, meaning if you have a plan to max fund a policy at 10 grand per year, 50 grand per year, 100 grand per year, whatever your dollar amount is, you've got a plan to max fund it, but then you don't, will that impact the policy as follows? Will it take longer to break even? The answer is typically yes. We're going to show a demonstration. And then two, do you have to pay longer than planned? So as an example, if I plan to pay in $100,000 per year for 10 years, and I've got a policy with a $10,000 base premium, a $100,000 MEC limit, so okay, I've got a plan to get this $1 million into a policy, 100 grand per year. I think I can do it. That's my plan. But then life happens. Things don't go according to plan. Maybe you get in 100K for only 5 years, then stop. Maybe it's 50K for 10 years. Let's say 50K for 10 years. The specific question here in part B is, okay, I plan to pay in 100K per year for 10 years. Life happened. I can't get it in. I got 50 in for 10 years with the policy that was designed with a $10,000 base premium. Do I have to pay longer than that 10 years since originally it was equipped to handle $1 million over 10 years and I didn't get it in? The answer is no. You can continue to fund it. So we're going to look at several different variations pretty much with the same policy and then one additional option. But what we're going to look at here is whenever we have a plan, which plans always change for everyone over time, but if we have a plan to pay in $100,000 per year for 10 years, we've got our 100K MEC limit, I want to see what it looks like if I follow through according to plan, 100,000 per year for 10 years. But then what if life happens and I take that same policy that was optimized for 10 years, that's the key there, and stop after 5 years? Because if my plan was to only fund it for 5 years, I'm going to design that a little bit different. I'm going to go with a smaller term rider on a 5-year compared to a 10-year just to reduce my costs further and bump that internal rate of return. Always depends on the individual's preference. So again, just to stay on track, plan 100K for 10 years, look at that, then the same policy with only 100K for 5 years, then the same policy with a 10K base premium and the 100K MEC limit, but with 50K for 10 years, and then stopping altogether. 50K for 20 years. We're even going to look at 50K for 5 years. That's an option too. So my point to mentioning that and what to illustrate is we can stop early if we want to, which is really nice. And then what if I only do 20K for 20 years? Look at different variations. Now we're not going to look at all of these variations, but the majority of them, we're just going to give you some samples in respect to what it would look like. So again, policy design. Here's the sample we're going to follow, that $10,000 base premium. So we've got a 10K base premium with the ability to pay in another $90,000 per year into PUAs. Now, if life happens and he cannot, if this is you, if you cannot get in the original plan, which was what? 100 grand, when you add those two together, you say, hey, I can only get in 50. I can only get in 15. Maybe I just start with the minimum. What's your true minimum? That base premium. So what I want to touch on here is when you first set up that policy, wherever you set that minimum premium, that's your actual commitment when you start a policy. I'll add where a lot of people are attracted to the idea of a 10/90 split or a minimum premium policy is the high cash value, especially when you look at the guarantees, but really the flexibility. I'm committed to a lesser amount, and that really just gives me as a consumer, I hear this frequently, peace of mind. I don't feel obligated or committed to this big bill in the event that life happens. Maybe my cash is tied up elsewhere, but that flexibility piece has really given a lot of people a lot of peace of mind, and it's helped a lot of people too when life has happened. Real estate investors, they don't get the amount of funding in initially, then they sell a piece of property and make a huge catch-up payment and make up for lost time. We've seen that too. So let's take a look at some examples and looping back to this, answer these questions specifically. If you don't max out your PUA rider, so I don't do everything according to plan, will it take longer to break even? And do I have to pay longer? So the answer here, no. We're going to look at the numbers to validate. And then here, also no. but you can continue to fund. So anytime we look at side-by-side comparisons or different samples, what I like to look at, pretending that it's me, if I'm the individual, the questions I would always ask my superiors years ago when I was learning about a lot of this, and I still ask questions, is stick with the original plan, meaning I don't want to tweak or adjust the design. Keep all things equal. Plan for 100K for 10 years, paid 100K for 10 years. Assuming this was the individual's original plan, starting at age 45, okay? 100K for 10 years, 10K base premium, almost $83,000 right off the bat. This is a product that complies with the new 7702 changes. Break even, year 5 in this example. As we scroll our eyes to the right, to the middle example, let's circle this in green. What do you notice about the first 5 years? Everything's identical because it's the same policy. The only difference here is that we are assuming life happens and you can't pay another penny into the product thereafter. Hey, I say you can pay in the base premium. You say no, like I can't pay anything in. And for transparency's sake, because this is on Excel, years 6 and 7, the 10K base premium is technically still due here, but we're not paying it. The policy is paying for itself. And then year 8, we cut the term rider. Actually, we did not go reduced paid up on this one. Cut the term rider so we can keep funding it if he wants, but you see the death benefit drop there. But main point is we see a pivot here. Plan to pay for 10, couldn't do it because life happened. What's it look like if I still get 100K per year in, but then stop after year 5? Compared to the option on the far right, let's put this in red, plan for 10 years, but I only paid in 50 for 20. Not optimized. So what I wanted to do in this example was get the same out-of-pocket $1 million total. So 100 times 10 is $1 million. 50 times 20 is the same million. But here's the big thing. You got 50K going in with a $10,000 base premium, which effectively is a 20-80 split. Now, granted, you have window room to throw in another $50,000 for a total of 100K per year, but we're getting 50K per year in. There's your cash value, $36,000 right off the bat. Break even point is when? Between years 6 and 7. So not bad, not horrible by any means, but we do see the difference there. So I plan to max fund it. The first question is, will it impact my break even point? And there's the answer. This is the same product, same company, health rating, all things are equal here, just paying in less. See the death benefit's the same on the far right too. Same million in, 1.525 in cash value, compared to the example where you got it in over 10 years, $2,060,000, over $500,000 more. Same out of pocket, but time value of money, you get it in over 10 years, so of course it's gonna crank faster, it's gonna compound faster for you, and you optimize the design too. I mean, we're 10xing the base premium, shoving more money into the product each year, taking advantage of the term rider, funding up to the MEC limit or the max we can. Like that's optimized. This example was life happened. I still want the ability to go up to 100, but I didn't do it. I just paid in 50, so now I can see it up front. Now, if this was the case, as we have our review meetings and reach out to everyone we work with 6 months, what I would do and what our company would do is continue to have the conversation. And if we felt and the consumer feels that, hey, I'm getting a max of 50 in, is that likely going to be the max you're going to get on any given year? Yeah, I don't foresee myself getting to the 100 anymore. What we would do is actually scale everything down. You can always reduce the death benefit, which reduces the MEC limit after starting a policy. Same thing with the base premium. So we can peel that down to 5K, still get the same 50K in, and improve performance. Very easy to go down, difficult to go up. It requires underwriting, and sometimes you can't do it. Let's look at another variation here. So what do we see here? The first two are identical. Plan for 10, paid in for 10. This guy, plan for 10, 50 for 20. This is the exact same example, the exact same thing. Example on the right, planned for 100 for 10, life happened pretty severely here. Got in 50, but stopped short. So not only is the policy not optimized, meaning I'm not 10xing the base premium when I had planned to do that, but it's not optimized and I have to stop short. So the question, if we go back, was what? Will it take longer to break even? And then would you have to pay longer than planned? So when I see or hear no, you wouldn't have to, you'll be okay. Okay, that gives me some peace of mind. Can you show it to me too so I can actually see it? Like I'm that guy, like I want to see it before I move forward. Just because, so many things happen all the time where we're told one thing and then something different happens. Like, no one likes that situation. So what do we see here? If you still heavily fund a PUA rider. So here we're still, we're 5xing our base premium in terms of a total payment. 10K base, shoving another 40K per year into PUAs, a little bit less because of a term rider, but that's still a healthy fund overall. So what do you notice here? It still breaks even between 6 and 7. That is not bad at all considering how we equip the policy with the original planning. Now, if we were to scale that down to 20K, would not look that good. It would take longer, about 10 years, over 10 years actually to break even. But that's the kind of stuff I want to see up front, and we look at that. When we get to the final stages, and I mentioned this before we look at the third option, when we get to the final stages with anyone we work with, I'm a huge fan of showing them, hey, here's the original plan. Say it's 100K for 10 years. But here's what it looks like if you only pay in 50K. Here's what it looks like if you pay in just the minimum. This way they see it up front and there's no surprises. As the agent, we can never assume that someone's going to understand this and know exactly how to navigate through the stuff like we can. It's our responsibility to build awareness around the important parts, like driving a car. Here's the steering wheel, gas, brake, all that good stuff. I don't need to go under the hood and explain how the mechanics of the washer fluid work, if that makes sense. Plan for 100 for 10, funded for 10, then a different one here. Plan to pay 100 for 10, but paid in 50 for 10. So specifically what I want to highlight here, here's your base premium. Break even point is when? Between 6 and 7. So not bad, but not great. Now, compare that to the same policy for the consumer in respect to 50K out of pocket for 10 years, but kicking the base premium down to $5,000, cutting the death benefit in half, which has to do with the MEC treatment here. So what's interesting about this, what do you notice? Highlighted in yellow represents your break-even point. The guy on the far right is going to match more so the guy on the far left from a performance standpoint, because the ratios are the same. Here, you've got a $10,000 base premium, 100K per year for 10 years. Here, 5K base premium, 50K for 10 years. Compared to the middle option, which is 50 for 10, but a 10K base premium, higher insurance expense, where I thought I could hit it, but I couldn't for whatever reason. So this is good stuff to see up front. I do hope it provided an answer to your questions. Thank you so much for the questions. If this was helpful, please hit the like button, subscribe button. Feel free to call or email us anytime. We always love connecting with people. And as always, hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.